So, welcome to another episode. So, today we have Fadi Habib on, who is the founder of Legacy Wealth Builder Academy. So, welcome to today's show, Fadi.
Welcome, Jivan. Happy to be here.
Thank you. So, finance is a funny thing. It's such a broad spectrum. If people say, I'm in finance, what do you mean by that? Are you an accountant? Are you a management accountant, a financial accountant, an investor, a trader, a financial advisor, a tax accountant? What exactly are you? So I would put that question to you. What's your remit within the financial markets?
Okay, so I actually don't consider myself in finance. I consider myself in education. So I'm not a financial advisor. What I do is that I teach people how to approach the stock market um, in a responsible way. A little bit of history about me. I am an engineer. I have a master's in engineering. I came to Canada 25, 30 years ago, and I've been in corporate all of my life in project management operations, something called Lean and Six Sigma business improvement. But my passion was in answering the question, how can I be wealthy? Because it was very clear to me engineering is not the road to wealth. So I read this book called Cash Flow Quadrant long time ago by Robert Kiyosaki, and I learned that the way to be is not an employee. I had to be an employee because I have to pay the bills, and I have a lot of bills. And by the way, most of my work has been high paying jobs. It's not that my salary was small, but again, it wasn't enough for me. So I learned that I have to be in being in the right side of the quadrant, mainly being an investor. So I didn't understand what does an investor mean. So I asked, they told me it's real estate and stocks. I really hated stocks. So I started in real estate and I did very well, made a lot of mistakes. Of course, when your dad is not a business person, my dad is a doctor, you have to teach yourself all of this stuff. So took a lot of courses, did very well in real estate. And then 15 years ago, somebody told me, Fadi, um, there's this course about options, you need to come. And I hate the stock market because I believed then that the stock market is a casino because everybody around me was losing money. So for me, anybody who goes to the stock market is not a responsible person. So basically, what I went to the course just to prove to myself that I'm correct and the guy who's speaking doesn't know what he's talking about. But I was pleasantly surprised that in the world of investing in the stock market, there are different profiles. There is the person who is a long-term investor, who's very responsible, like Warren Buffett, who buys something and waits for 30 years. That's a really responsible way, but I don't have 30 years. And there's also the day traders, which I hate day trading because the amount of stories I hear about people losing money in day trading is humongous. So day trading and scalping, which is scalping for everybody, um, is a worst method of doing day trading. It's going in and out in few seconds. So for me, day trading and scalping is a sure way for the masses to lose money very quickly. And this zero DTE. I was just talking to somebody yesterday. He lost $200,000 in this zero DTE. So there's a big spectrum, and we always hear about the people who are losing money. The problem also with that is that we're also hearing about people who uh, tell you that I made $100,000 in 2 weeks and all this get rich quick schemes. So my goal, my passion is to teach people how to invest properly in a way whereby you get good ROI, but in a way that does not put your capital at a lot of risk. That's the main thing because people think that the objective of everybody in the stock market is to get the highest ROI, which is a disaster if this is what you're thinking. Your job is to protect your capital, same as what Warren Buffett told us. Don't lose money. That's the first rule. And the second rule, don't lose money. So protect your capital. Number two, get the best ROI. So I consider myself as a financial educator and somebody who helps people to get out of the rat race, basically.
Yeah, I love all of that. I love all of that. I've made a few notes here because I think with podcasting especially, and the fact people tend to give quite long answers covering a lot of topics, it's nice to sort of note down things and go over them individually. So I think first thing is the rich dad poor dad thing. As you said, sometimes your parents aren't
Yeah.
educated in a certain space and you haven't been exposed to that. So then nowadays we have to go out into the open market and say, okay, let's learn an options, let's take an options course, whether it's buying or selling options. Let's look at an investing course, whether it's long term or in something else, that is equities, bonds, etc. And it's down to us as an individual to listen to the right podcasts, to speak to the right people, to maybe speak to people in our friendship circle to try and understand these things, because it's all well and good reading books, but unless you can converse about how it works, your understanding is limited by that, I think, as well. So coming
Correct.
on to what you prescribed, I suppose, initially is to keep away from scalping, day trading, and essentially short-term investing on, people use 5-minute marks, 15-minute trading candles,
Yeah.
etc. On the flip side, though, would you not say there are successful people who do that in terms of they can, as you said, protect their capital through stop losses, etc., where they can limit capital but also look at upside potential? Or are you more on the side of, well, actually, it's too speculative? Markets and asset prices can fluctuate so much in a very small space of time that it's very difficult for you to profit on that. But if you look at a long term options as an example, you have
So
a much larger understanding of how prices change due to supply demand or whatever. Like oil as an example, you saw in the past when they overproduced oil, the price of oil then drops because there's a much wider supply than there is demand, for example.
let me answer two things. Number one, I myself, I don't consider myself as a long-term trader. For me, I'm a swing trader, so I go in and out between 2 weeks and 6 weeks. But the objective, the view, I am adopting a long-term view, and that's the difference. Okay, but I do want to comment on the day trader thing. You're saying, don't you see any successful day traders? I gotta tell you, out of the 2,000 people I know, I can't name couple who I consider successful day traders. And if somebody is telling you I made $100,000 in 2 days or 2 weeks, ask him, ask him, how many accounts did he blow up? Okay. And if he's honest, he's going to tell you blow up mean completely zero the account.
Yeah,
Okay.
most accounts turn to zero within 30 days on day trading.
Okay. So the other question I want to ask you, do you know any billionaire who is a day trader?
No.
Name one. Okay. You know why? Because it's not doable, because it's not consistent. The issue is not, I'm not saying you cannot make money for you, but it's like a lottery. You can make money once, but you cannot rely on it as a consistent way of making money because it's very speculative and you're betting on a market that people do not understand how to look at the market in the short term. In the short term, the market is a drunken party for teenagers. There's no logic. It's all about emotions. It's people running, tariffs, COVID. So it has nothing to do, whatever prices you see for the stock market in the short term has nothing to do with the value of the company. So a company can be really bad, stock is going up, company can be really good, and the stock is going down. And you need to understand how the market behaves. The problem is most people do not understand the market, do not understand the behavior of the market. Even sophisticated real estate investors, where they will never buy a property without asking what is the rent, what are the expenses, is it cash flowing, basically asking, evaluating the asset that they will buy based on business acumen and sense. They completely don't do that when it comes to the stock market. The level of research they do is that they ask their friends, like where their friends tell them this is a good company, and they might just go and see what the analysts say about it, and that they think that's research. You need to evaluate it's not lottery tickets. People buy. That's why a lot of people are losing money in the stock market because they approach it as a casino. It's the same as you're using a knife in a kitchen. If you're using the knife and it's cutting you, it's not because the knife is bad. It's you not knowing how to deal with it in a safe and proper way. And you can do wonders with a knife. But if you don't know what you're doing, if you're holding it in the opposite way, it's gonna cut you right, left, and center. So I don't believe in day trading, full stop. And people don't understand that it for the 0.001 people who lost money and now they're good, right? So very, very small percentage of people are successful at it. It's not for the masses, though a lot of masses are going into it and losing money. I get a lot of calls, Jivan, with a lot of people losing money because of this. So I'm telling you that's not the right way. And you have been losing money, there's a reason for it because it's not a consistent way of doing things. The other thing as well is that it needs tremendous amount of time and skill. Okay? So if you're having a full-time job or if you're somebody who's not fixated on the charts all day. There's no way you can be successful. Like physically, there's no way because you need to manage stop losses. You need to be looking at the small time frames, and it's just not doable. And if you do that, I'm telling you, the chance of you being successful is very small. Not because you're not smart, it's just because it's not a consistent way of responsible investing, in my view.
Yeah, it's they say, don't they, that retail investors are liquidity for like big corporate prop firms
Yeah,
because
yeah,
essentially they are the liquidity to come out of trades. And also I've heard as well was that
yeah,
these trading platforms, they essentially take the other side of people's trades because they
and
know they're
yeah,
going to win then. Because
yeah,
most people are bad at trading. It's like as you said, the gambling example, perfect. A casino, they're betting against everyone. They know most people are
yeah.
going to lose, then they win. It's the same thing. So
It's the same thing.
a lot of these firms, what they tend to do is they give you free courses, but the courses are absolute bollocks, for want of a better phrase, because they
Yeah.
don't teach you anything about finance. They say, oh, if the chart looks like this, just do that. If it looks like this, just do that. And people follow that sort of technical analysis, should we call it, in order to try and win. But as I said, if that firm has got an interest against you, why would they
Yeah.
train you in a way that's
And
going
here's
to
the
win?
thing.
So it's crazy.
Most people don't know that they see your orders. They see all the orders and they have all the information about what you're ordering. So, and what the market orders. So they have a huge advantage. I guess what I'm saying is there is, for your listeners, there is a way to learn how to do this properly, not to do day trading properly because it's never for me, it's never proper day trading. There's a way to do this properly with getting beautiful ROI. For me, 24% is a beautiful ROI. And for me, this is the sweet spot whereby I get good ROI as well as not put the capital at a lot of risk. Why is 24% a good ROI? Because it's double the market. The market usually gives about 11%. That's the SPY for the last 20, 50 years. So if you do double the market, you're doing well. With 24%, you can double your money in 3 years. That's beautiful.
Of course, of course.
Okay.
So sorry, go on.
Okay, so that's beautiful ROI, but the genius of it is not the ROI. The genius of it is that you don't put your capital at a lot of risk. There is absolutely no advantage for you going donating your money to the people who are or big firms, right? So you need to know what you're doing because if you don't know what you're doing and you go to very risky stuff, um, your money will be taken. The way I say it is like this. I live 1 hour away from Toronto, Canada. And for me to drive to Florida takes about 24 hours. If my objective is to reach Florida in 3 hours driving, I might know how to drive, but because I have the wrong objective, I will have to drive at 900 kilometers per hour to reach Florida in 3 hours. That's the only way. And even if I did not get involved in an accident in the first hour, it's an accident waiting to happen. I will be, I can assure you, chances of me reaching Florida driving at 900 kilometers per hour is zero. I will be involved in an accident. It's the same thing with investing. If you go for really high ROI, and I talk to people who actually believe that they can do 100% every year, if Warren Buffett is doing 20% per year, why do you think you can do 100% every year? And I talk to people telling me, let's say I want $10,000 per month. Okay, how much capital are you working with? $10,000. So I'm telling him, you want 100% every month, meaning 120% every year. Do you know that Warren Buffett, the king of kings, is only doing 20%? So I guess what I'm saying here, if you chase really high ROI, I know the end of the story because I talk to people every day getting scammed, losing their money in risky investments like day trading, going through like uh, risky strategies on crypto trading. You don't need all that, right? You don't have time to. I don't have to. For me, I don't have time to waste money. Like I'm old enough right now that I want steady, good growth, good uh, solid ROI in a responsible way. If you can't sleep at night, if you're worried about your investment at night, I'm telling you, you're not investing. You're gambling
Yeah,
because
I mean,
investors should be very, yeah, calm. Go
this
ahead.
is it for the most part. Retail investors either do one of two things. It's the day trading because they want the quick buck,
Yeah.
or
Well,
they go the
yeah.
other end with mutual funds. They just put it into a mutual fund. They don't really know what's involved in the mutual fund. They give it over to this investment house and they do their work. So, what's your um, prognosis then. So what's your way of investing? Because you mentioned options. Is it
Yeah.
buying options, selling options, or a combination of the both
Yeah.
of the two?
Okay, so the idea is very simple. I like to stack probability on on my side, and I don't want to manage. So my method of doing things it's really designed for busy professionals. So you only need 10 minutes a day. You don't have to look at charts 6 hours a day. I don't have time for that. So for me, it's very simple. I learned that selling options gives you much better probability than buying options. Okay, because there's something called theta. I don't want to go into much technicals, but there's huge advantage for you to sell options versus buy. So that's the first thing. I don't buy, I sell. Number two, there are 50 different types of doing options strategies. I only focus on two or three that are low risk, right? I don't go for the fancy spreads and butterflies and all this stuff. I just go to something very simple whereby if basically the worst case scenario is that I will buy a stock at a discounted price. I will never book a loss at all with my method.
So cash covered.
So, yes, cash secured put.
Yeah,
Okay, so that's
basically.
an integral part
So,
of
so
it.
you're
So
so
the
you're
idea,
selling put options on stocks that are going up in value, like Microsoft, for example.
right, on really, really good stocks. So this thing that I'm doing here does not work if you're doing it on really bad stocks.
I've got my friend's dad actually does something very similar to you. He sells put options on Microsoft and just basically collects
Okay,
a premium. That's it.
okay, good, correct. So Microsoft is
And
really
cash
good.
covered. Yeah, cash covered. That's
Yeah.
it.
Some people use this method on really bad stocks because if you do it on bad stocks, you will get paid much more. I have stocks that will give you 20% a month, but I will never do it because it's a really bad stock.
Yeah.
Because whatever you do, you need to understand what is the worst case scenario. And if you're not okay with the worst case scenario, you don't do it, right? So for me, the worst case scenario is that I'm going to buy a stock. So if I'm going to buy a stock, I want to make sure that it's a really good stock. Because Peter Lynch said this is something that can make your listeners a lot of money if they understand it. The, Peter Lynch said there's absolutely no correlation, often no correlation between the price of the stock and the value of the stock in the short term. Meaning, if there's a stock that is $600, this does not mean it's a good stock. And if there's a stock that is $4, this does not mean it's like the price and the value of the stock has nothing to do with each other.
We saw that in the internet bubble, for example.
Yeah. On the other side, he said that there's 100% correlation between the price of the stock and the value of the stock on the long term. Meaning, you have a stock like Meta is $600. That's a cheap stock because they are pumping cash, revenue, profit. They're really solid company, and it's at $600. And for me, that's cheap because the real value of it is 800 if you look at the intrinsic
So
value
you're
versus,
looking for just to sort of
yeah,
talk this through. You're looking for arbitrage, pricing arbitrage with regards to options trading.
I'm not
To an
sure if
extent
this,
so what you're saying is long term the price reflects the actual company, but short term
yeah,
that might not be the case, so you're looking for
based
that
on Peter
arbitrage
Lynch.
difference where it's
Not
undervalued
not arbitrage.
essentially.
I'm kind of what I'm saying is I am if I am okay to buy a stock at a certain price, I can actually make money with cash secured puts with that. But I don't do it except on stocks that I know will go up in value in the long term. And long term is about 5 years. So BlackBerry at $4 is an expensive stock compared to Meta that is 600 because BlackBerry is losing money. So basically, you need to understand the balance sheet, cash flow statement, and the income statement. You should not be involved in any company that is losing money. Full stop. Because that's not the objective of a business is to create profit. If the company is not making profit, it cannot be, in my view, investable. Because why would you buy a McDonald's that is losing money? No. Why would you buy any company? And by the way, do you know that almost like 47%, if you go to the 6,000 companies, go to any screener, the 6,000 companies in the market, if you just say, if you filter on the ones that um, can are making money, I think what will you will see that only 3,000 out of the 5,500 are making money. Huge amount are not making money, which is not investable. So anyway, I have a free screener that I can give anybody if somebody just text me a message or something, I can send that. But there's a lot of free screeners that can tell you what is a good company or not. filter on the ones that are making money, filter the ones that have income, filter the ones that have something called free cash flow, because a company that has free cash flow can invest in R&D, can can buy back stocks, can acquire other companies, and of course, profit.
But what if someone wants to trade options and they don't have the cash to basically cover it if it goes? Because for those who don't know, basically, if you're selling options, you could lose if the stock goes to zero. You could lose a lot of money.
If you're selling, you lose. No, not with the way I'm doing it. Why would you say if you sell, you can lose?
No, as in
Why?
because if you it depends on the option difference. Because if you're selling options and you're expecting the stock to continue going up, and they can basically have the option to sell the stock, and it
So,
goes to zero. That's why you've got the cash covered to alleviate that issue, essentially.
okay. Can I explain what I do? Because
Of
there's
course,
no losses here.
of course.
So very simply, um, I'll just do a scenario with you. Okay. Um, you have 100 shares. I have 100 shares of Meta. Okay. And I bought it at 675. And I am so afraid that it's going to go down to 650. Okay. So afraid. Okay. So that's me. I don't understand the value of Meta. I'm a normal guy. I'm just so afraid that it goes to 650. Okay. But I bought it at 675. You are a sophisticated investor, Jivan, and you like Meta. You know that the intrinsic value of Meta, the real value, is 815. So for you to buy it at 675 is a good deal. It's already underpriced. Okay.
Correct.
So I come to you and say, Jivan, I heard that you like Meta, and you say yes. And I heard that you want to buy Meta. You say yes. Okay, Jivan, can we make this agreement that if for the next month, if the shares went down to 650, would you buy it from me at 650? And Jivan, you will think about it and say, I wanted to buy it at 675 anyway. 650 is a good price. It's even discounted. And if we agree to this price, by the way, this is a real example. And for you, if you agree to that, you're gonna get paid $1,800. So you collect premium, which is the income generation part of
Yeah.
this.
Yeah.
So from your point of view, if the market went up, so if it ended up 680 in the next month, you made $1,800. If the market stays the same, you made money. If it went down but did not touch the 650, you made money. Worst case scenario is that if it went down below 650, you will just have to buy it. Okay. In the four scenarios, you made the $1,800, which is the profit. And the worst case scenario is that you will need to buy 100 shares of Meta, which is a good stock because we're only doing this in good stock. With good stocks, it will increase in value with time. So you didn't lose anything. So where's the loss here? Like I'm just like
No, but then let's just go a little bit deeper because let's say, and that's why I asked if someone doesn't have the cash to be able to buy that many shares, first of all, they've over leveraged themselves. That's
okay.
one thing.
So that's a
And
different story
two,
than losing because
but
there's
this
no
is it.
losing here.
It's a wider picture. So it's practicality as well as obviously if you have this available. Because what will happen is some people might be like, oh, do you know, I'm going to do it. I'm going to. They've looked at a few videos online and they try to replicate this, and what they don't realize is they've over leveraged. They can't afford to buy these
Very
stocks back.
important. Good point. Absolutely no leverage. One of the main rules that I have here is that forget about the ROI. We don't want to lose our capital. Absolutely, with this method, no leverage. Um, Nobody should be using leverage anyway with stocks. I will never buy a real estate property without going to the bank and getting a mortgage. I will always do that in real estate, but not in the stock market because it's a different beast. It's if you have two different pets, you need to understand that the dog is different than a python. By the way, the reason I'm saying python because one of my rental properties, somebody wanted to come and rent with a python, big python. Anyway, so if you have a dog, you need to understand how they feed the. It's different than a python. The real estate is different than the stock market. The stock market is very volatile. You cannot use margin. Disastrous things. So I agree with you, no margin. There's a two different problems. One problem is how can I come up with a capital? That's one. Number two, you said something about losing. So I was just commenting that there's no losing here. But you're right about the capital. You need to have a little bit of capital. I usually recommend 5 to 10K to start. But yes, it needs a little bit of capital. But I don't like the fact that I don't have capital should not force me or push me to do risky strategies. For me, this is not a risky strategy that much because I'm using it on good stocks.
But let's play worst case scenario. So the example of
Yeah.
650. Let's say that some news came out that Meta had some dodgy dealings going on in the background,
Yeah.
and market sentiment essentially drove that stock down to 50. And it's not going
You
to
know
happen, of
what?
course, but let's say
Let
it's
me give you
50.
let me give you a better real example. Meta at some point was at $400 and within a year went to $80. Okay, let's take that example. That's a real example. I have the chart for it. So Meta was $400. Let's say you sold a put at 300. Okay, and then it kept going down. Okay, and you got assigned, let's say at I don't know 250 or something. So you had to buy it at 250, and then it kept going down, down, down. Okay, have you lost? For me, the definition of losing is that if you sell it at a loss.
Yeah,
Okay.
correct. Yeah, correct.
Okay. Okay. So the normal psychology of people who don't understand what they're doing in the stock market is that this is what's can happen, what's happening with everybody. They see a stock going up, they think it's going to go up more, they buy it. Usually they buy it at the top. They wait till it goes down, they panic and sell at the bottom. Okay. So if you see yourself in this pattern, it's because the psychology of a normal person who does not understand what's happening is this is what's going to happen. You're going to always buy the top. You're going to always sell at the bottom, booking a loss. That's all what we're doing here. If a good stock like Meta goes down to 80, I'm not gonna sell. I'm not gonna panic and sell. That's because I'm gonna book a loss. What I'm gonna do
Correct.
is that, you know what I'm gonna do? I'm gonna go try to get all the money that I can to buy it at 80. If I know that intrinsic value is $500 and now it's 80, people in the real estate market love to buy a property at a discount, right? They love to search for people who are motivated so that if a house that is $200,000, if it's being offered at 100, that's a steal for the real estate investor, right? The stock
Yeah.
market gives you that almost every month, every day. When the stock goes down, everybody will be selling. What do you think is that? Most of these, not most of these, some of these are stocks that are like this example. It's worth 200, they're offering it at 100. Same as Meta. It was at $400 and the value was around $400 and it was being offered at a huge discount, 20% on the dollar.
Yeah,
So
I
people
think the
just,
difficulty for people is though is to differentiate between those that have gone down, as you said, temporarily, which is when you buy because it is going
yes,
to
yeah,
rebound, and versus ones that are going to go down and they're going to stay down because they are losing money. It's a bad
correct. So
company. That's
they
the difficult
need
thing for
this.
people to get.
Yeah, correct. And they need to, here's the thing, you need to learn. It's not a casino whereby you don't need to learn and just go. You need to learn how the stock market behaves. You need to learn how to evaluate stocks. You need to learn how to figure out if this stock is cheap or expensive, right? That's the first three modules of my coaching program is that, and you don't have to come to my program. What I'm saying is that you need to answer these questions for yourself. Otherwise, you will be gambling, right? So if you don't know the answer to these questions, just don't go buy anything because it's not going to go well for you. By the way, Meta, after going to 80 in within a year, went back to 700. Okay. So what I'm saying is that yes, it needs a little bit of capital, but not huge, in my opinion. If you do it properly, you will be able to sleep at night because all what you will be, if you have the right mindset, all what you'll be thinking of, if you believe that Meta is a good company, which it is, you'll be going around trying to get money to buy, not panic and sell like everybody else, right? Think of it this way. If you're buying tomatoes every day from the market and it's usually $5 per kilo, you know the price, $5 per kilo. If one day you went to the market and I don't know, they had a lot or something and they were offering it at $2, what are you gonna do? What people do is that they go home, get the tomato that they bought yesterday to sell it at $2. Like,
Yeah,
if the market,
correct.
yeah, if the market is giving you something good at a discount, you need to leverage that, not panic and sell what you have. But of course, you need to have the skill of figuring out what is good and what is bad,
So,
right?
an example I use when speaking to clients in finance is like you have three types of investors. Like use COVID as an example. Market went down 25
Yeah,
percent. You have ones that panic and sell at the bottom, lost 20%. You have the
yeah,
ones that just let it ride and it comes back up to where it was. They didn't lose anything. They did,
yeah,
as you said, on paper. They didn't actually physically because they didn't sell it.
yeah.
And the third type of investor actually buys more at the discount. And out of the three, who made the most money? The one who bought extra at discount. But for most people, they don't think like that. And it's very difficult for them to understand the psychology versus the mathematics behind it, if you want to call it mathematics.
Mm.
So yeah, it's quite difficult for people to understand. But once they do, I think, as you said, and I think that's a really good example where, with regards to properties, people look for discounts in
Exactly. It's the
properties and
same thing.
cars and everything,
Yeah.
but they don't look for it in the stock market.
Yeah.
So could people do this with a single share? So, or
No.
you said
So with options, yeah, with options, every contract is 100 shares, and that's why it needs 5 to 10K. So options are dealt in contracts, and every contract is 100 shares. So you can deal with one share.
so to get started, they wouldn't maybe start a meta because if it's
Correct.
100
So what we
shares
usually
times
do, I
600.
started with 10K, by the way. What we usually do is that we search, and it's double, we search for good stocks that are less than $100. Okay. So there are stocks that are good, good meaning profitable, cash flow, good debt ratio, all of these stuff have good moat, all of these stuff, but cheaper till we build up our capital to get to the meta.
So if
So
people
Netflix,
want,
Netflix right now is $100, right?
yeah, so
They
if
just
people
they
wanted to
just announced.
learn this
Yeah, they just
strategy,
announced the 10 to 1 split. Yeah, go ahead.
if they wanted to learn this strategy, could they learn it themselves, or do you think it's worth coming through your course because you've done it? You know the pitfalls, as you said, you had made mistakes in the past,
So
and they could
yeah.
work with you as a
So
one-on-one mentor
there are
conversation.
three levels if you start it. The first way is you go learn from YouTube, a free source. Okay, so that's one. The second level is that you can buy a course. I don't offer courses, by the way. But if you buy a course, it usually people who give a course, it's structured in a way. The bad thing about the course is that there's no one-on-one, there's no coaching involved. So there's the free stuff on YouTube or any other source. There is a course and there's mentorship. So three different levels. And there's so many people doing mentorships. So you need to look for, there are people who have mentorships and have like hundreds and hundreds of people. And there are people who do mentorships that are very small in size. Like my mentorship cohort is usually 5. So you go and figure out what is the level that you want, right? Of course, the more you go into a mentorship, the best thing is one-on-one, but usually it's very expensive. So go one step at a time. If you don't do anything, start with YouTube. What I do as well is that I do a lot of master classes, 3, 4 hour master classes, and it's usually extremely cheap. That people can come and just learn a little bit more about this financial literacy and what I do. But for anybody out there, first thing is go to YouTube. There's a lot of free content. Second is find a course if you're really serious about it. Get a little bit more focused education because on YouTube there's so many things about so many things. It's chaotic. And then the best thing is mentorship if you're really serious. But you need to choose because there's a lot of people out there who charge really expensive packages and they don't give you the real attention. So you got to do your homework. Same as you're buying anything, like buying a car. You need to figure out. But you always start with free to understand a little bit more.
Perfect. So, number one, if people want to do it themselves, I think, do you know what? I'm going to try this myself. What sort of platforms would they use? And secondly, if they wanted you to help them, how would they reach out to you?
Okay, so I have best thing is YouTube. I'm also on LinkedIn. So my company's is Legacy Wealth Builder Academy. You can go to my website, legacywealthbuilderacademy.com. So you can find me on YouTube, Facebook, Fadi Habib, Fadihabib, and LinkedIn as well. All of that you can text me and I'll send you the screener and tell you about the masterclass.
Perfect. Well, thanks very much, Fadi, for your time. And yeah, even myself, similar to my friend's father, you trade in a very similar way, and he's been very profitable as well. So it does work. So yeah,
Beautiful.
thanks for sharing that with us.
Jivan, I enjoyed talking to you. It was a pleasure.
Thanks, buddy.